Silver has occupied a peculiar position in global markets, caught between industrial demand and financial speculation. Institutional reports suggest that its price movements often anticipate shifts in broader risk sentiment, yet they rarely follow straightforward patterns. Recent trading volumes hint at an underlying tension between long-term accumulation and short-term positioning, raising questions about which forces truly dictate price direction. Market participants note that Wall Street's activity, especially through large-scale derivatives, has quietly intensified over the past quarter. Data indicates a subtle clustering of contracts that could influence near-term volatility, but the implications are far from linear. As these positions evolve, they may set the stage for unexpected pressure points, though the exact triggers remain opaque. Available filings suggest that certain institutional investors have been quietly increasing exposure, while others appear to hedge aggressively against potential downside. This duality introduces a structural fragility. When one segment reacts to price signals, it can amplify movements that others are trying to mitigate. The interaction between these opposing strategies can be decisive, yet only if specific market thresholds are crossed. Evidence also points to shifting dynamics between physical silver demand and paper markets. Inventory reports indicate modest draws in some key storage hubs, even as futures contracts accumulate. Such divergence often precedes periods of dislocation, implying that observed price changes may not fully reflect the underlying scarcity or abundance of the metal itself. At the institutional level, margin activity offers a revealing glimpse into market sentiment. Analysts tracking COMEX filings note that leverage ratios for certain large positions have crept higher, suggesting growing confidence or calculated risk-taking among major players. Yet these same positions are sensitive to even minor shifts in interest rates or currency fluctuations, leaving the market exposed to rapid reassessment. Simultaneously, cross-asset behavior is beginning to play a subtle role. Silver is not moving in isolation. Correlations with equities, bond yields, and the dollar index show unusual patterns that may signal early structural adjustments. Traders who monitor these signals closely recognize that they could act as precursors to either breakout rallies or sharp reversals, but which scenario dominates remains uncertain. Emerging data from options markets adds another layer of complexity. Open interest in near-term contracts suggests that hedging activity is intensifying, yet the skew indicates that downside protection is being prioritized over speculative upside. Such positioning can create asymmetrical pressure. When volatility spikes, the market may react more aggressively than fundamental supply-demand would suggest, leaving traders caught off guard. Meanwhile, anecdotal intelligence from broker reports implies subtle shifts in institutional behavior. Large accounts appear to be fragmenting their entries across multiple instruments, potentially masking true exposure. If this trend continues, price signals could become distorted, making it increasingly difficult to interpret the intentions of major participants and setting the stage for sudden, sharp moves. Behind closed doors, some market strategists are watching inventory flows more closely than price charts. Reports from key vaults indicate that physical withdrawals are occurring at an uneven pace, with certain hubs showing sustained depletion, while others remain relatively untouched. This unevenness can distort conventional signals, meaning headline price movements may understate or overstate the real pressure building beneath the surface. At the same time, margin calls and settlement timing have become quietly influential. When concentrated positions approach critical thresholds, even routine adjustments can trigger cascading effects, forcing other participants to recalibrate their exposure. The market's sensitivity to these dynamics has increased, suggesting that relatively small shifts could produce outsized responses in pricing. Institutional hedging strategies further complicate the picture. Analysis of derivatives activity indicates a rise in multi-leg positions designed to balance risk across different maturities. While such structures are technically defensive, they can interact unpredictably with liquidity shortages or sudden spikes in volatility. The result is a system where intended safeguards may paradoxically amplify market stress. Finally, cross-border flows are emerging as a subtle but growing factor. While the bulk of trading remains concentrated in the U.S., reports indicate rising interest from international accounts seeking physical silver or synthetic exposure. These inflows can temporarily tighten available supply, creating pressure points that ripple through futures and options markets, though the timing and scale of their impact remain difficult to quantify. Historically, price consolidation phases in silver have been deceptively quiet, masking the buildup of strategic positions that only become visible once the market reaches a tipping point. Recent contract structures suggest that a similar accumulation may be occurring, with long and short interests increasingly concentrated around key strike prices. This clustering can create a scenario where even modest market signals provoke amplified reactions. Liquidity metrics reinforce this concern. Reports indicate that bid-ask spreads in certain futures contracts have narrowed, yet depth at those levels is limited. In practice, this means that relatively small orders could move the market more than usual, exposing participants to sudden repricing risk. The market's apparent stability may therefore conceal latent vulnerabilities that are not immediately evident from headline prices. Behavioral patterns among large traders add another layer of nuance. Observations suggest that some institutions are staggering position entries and exits across time, likely to avoid signaling their intent. While this strategy preserves discretion, it also creates intermittent pockets of tension that can surface abruptly when multiple accounts react simultaneously, potentially generating abrupt price swings. At the same time, data from collateral and financing arrangements implies that certain positions are under structural stress. Institutions relying on short-term funding to maintain exposure could face pressure if rates or margin requirements shift unexpectedly. The interaction of these pressures with market positioning hints at a fragile equilibrium, one where a small nudge could trigger a chain reaction. Available market intelligence points to a subtle but meaningful shift in trader focus, from purely directional bets to volatility positioning. Open interest in options has increased disproportionately relative to spot volume, suggesting that participants are now betting on price swings rather than a clear trend. This change alters the risk landscape, as sudden volatility spikes can cascade through both paper and physical markets in unpredictable ways. Meanwhile, reports from custody facilities indicate that the flow of physical silver is becoming increasingly selective. Certain hubs are seeing faster depletion, while others remain static, hinting that allocations are being prioritized based on client profiles or strategic positioning. This uneven distribution can amplify stress when futures and physical markets intersect, leaving some participants exposed to sudden liquidity constraints. Hedging strategies have also evolved. Multi-instrument overlays designed to dampen exposure to price swings appear to be more prominent among the largest accounts. While these structures are intended to manage risk, they can inadvertently synchronize responses when volatility shifts, creating feedback loops that intensify price movement rather than dampen it. Finally, currency and macro correlations remain a hidden pressure point. Observed deviations in silver's relationship to the dollar and treasury yields suggest that institutional models may be adjusting assumptions in real time. Even modest changes in interest rate expectations or dollar strength could disproportionately influence leveraged positions, meaning the market may react more sharply than conventional supply-demand analysis would predict. At the institutional level, margin and collateral requirements are quietly shaping behavior. Analysts tracking filings note that certain positions are approaching critical leverage thresholds, where minor market moves could force rapid adjustments. These forced recalibrations often propagate through the system, triggering reactions that are far larger than the initiating event. Simultaneously, cross-asset hedging appears to be intensifying. Some major accounts are linking silver exposure to broader equity and bond positions, creating indirect channels where market shocks in one asset can transmit pressure into another. The result is a network of latent vulnerabilities that may remain invisible until a trigger, no matter how small, sets off a chain reaction. Physical supply dynamics continue to intersect with paper positioning in subtle ways. Withdrawals from storage hubs have picked up while inflows lag, creating asymmetries that could feed into price gaps if institutional demand accelerates. These flows, although modest in isolation, can interact with leveraged positions to magnify market responses. Finally, investor psychology at large institutions is emerging as a quiet but decisive factor. Caution appears to be increasing around major announcements and macroeconomic indicators, with some participants adjusting exposure preemptively. These anticipatory moves can generate momentum in either direction, creating a self-reinforcing cycle where sentiment and positioning feed off each other, yet the tipping point remains uncertain. Recent trend analysis suggests that concentration of positions among a handful of major accounts is reaching levels rarely seen outside of high volatility episodes. When exposure becomes so centralized, even routine rebalancing can ripple through the market, producing movements that seem disproportionate to observable supply-demand shifts. Meanwhile, data from futures and options markets indicate that implied volatility is diverging from realized volatility. This gap implies that institutions may be overestimating near-term price swings, or conversely, underestimating potential spikes. Either scenario creates a fragile environment where small developments can trigger outsized reactions. Cross-border flows are quietly adding complexity. Reports indicate that foreign accounts are increasingly seeking synthetic exposure or physical silver in select hubs, subtly tightening local availability. When combined with concentrated domestic positions, this can create pockets of acute pressure that materialize in pricing anomalies or abrupt liquidity gaps. Finally, structural funding arrangements are beginning to influence market behavior in ways that are not immediately visible. Institutions relying on short-term leverage are sensitive to funding rate shifts or collateral adjustments, meaning that a minor shock in the broader financial system could cascade into silver positions. The interplay of concentrated holdings, funding sensitivity, and volatility positioning suggests that the market's current calm may be masking a network of latent stresses that could resolve abruptly once a key threshold is crossed. At the intersection of positioning, funding, and physical flows, the market is entering a phase where timing and coordination matter more than headline fundamentals. Analysts note that even small shifts in inventory, derivatives exposure, or hedging behavior can propagate through the system in unexpected ways, creating pockets of tension that traditional indicators may not detect. Liquidity fragmentation is becoming increasingly relevant. While bid-ask spreads appear normal on the surface, depth at critical price levels is thinner than average, meaning that orders large enough to move the market could encounter sudden resistance or unexpectedly accelerate a move. This creates an environment where conventional technical or fundamental signals may be misleading. Institutional discretion continues to shape observable trends. Reports suggest that large players are staggering both entry and exit strategies, potentially masking aggregate exposure. When multiple accounts adjust simultaneously, these hidden pressures can emerge abruptly, producing price dynamics that appear disconnected from reported data. Finally, the convergence of hedging strategies, margin thresholds, and cross-border flows sets the stage for a market highly sensitive to triggers that might seem minor in isolation. In this environment, small adjustments by a single participant, or even a subtle shift in macro expectations, can cascade, producing movements that ripple across both paper and physical silver markets. The implications for near-term pricing are therefore complex, and the next inflection point could arise from forces that remain largely invisible to most observers. Silver's near-term trajectory is shaped less by headline supply-demand and more by the interplay of institutional behavior, funding dynamics, and cross-market pressures. Available data indicates that concentrated positions, asymmetric flows, and layered hedging strategies have created an environment where minor shocks could cascade into disproportionate price moves. The market's apparent calm masks a network of latent stresses. Leveraged positions approaching thresholds, uneven physical withdrawals, and volatility-sensitive strategies all coexist in a fragile balance. Historical patterns suggest that when such conditions converge, price shifts can be sudden and significant, even if fundamentals appear stable. Ultimately, the behavior of a relatively small set of institutional participants may dictate the next phase in silver pricing. Their timing, strategy adjustments, and response to macro signals could either stabilize the market or amplify volatility, leaving broader participants navigating an environment where conventional indicators offer only partial insight. The takeaway is that Wall Street activity, when examined through positioning, funding, and cross-market interactions, may matter far more for silver's near-term path than supply or industrial demand alone. Understanding these dynamics is essential for anticipating where the market could move once latent pressures begin to resolve.